Hello, everyone, and welcome to another episode of the Market Snapshot series. My name is Rufus Kamau, Markets Analyst at FXPesa. So today, due to unavoidable circumstances, we couldn't start the session at the usual time, 11 a.m. So thank God we are here and we are able to continue with the session. So apologies for that. So we'll be looking at the top things that are currently moving the markets, including the progression of the US-Israel-Iran war, what has changed, and how we may respond to that in looking for opportunities to trade in the markets. So far, we have seen that the economic calendar is a bit quiet today, and that is usually normal, especially when you are just one day away from the official US non-farm payrolls. So that will be a key driver in the markets today. We'll be looking at what other things are moving the markets. So once you join in, kindly say hi on the live comment section. This will confirm that everything is just fine. You can already see a lot of you had already joined way earlier, including Sami, Mula, Kendi Jackson, uh, James Kabugi, Simon, Steven, and Thomas Mashuma. Thank you guys for joining. So let's get this started. So first things first, checking on the economic calendar. So as you can see, we have had quite a number of events since the week started. Of key note is the GDP quarter over quarter from Australia, which came in at 0.8% yesterday. This was way better than the expected 0.7% and also higher than the prior reading, which was 0.5%, which was revised. Then fast forward. Apologies for this. We had CPI data coming from Switzerland with prices increasing by 0.6% month over month, way higher than the prior reading of negative 0.1% and the expectation of 0.5%. And the key highlight for the week has been the ADP non-farm payrolls, which came in at 63K, higher than the expected 50K and way higher than the prior reading, which was 11K, which was revised down from 22K. So this shows a sign that the US job sector may be improving way better than expected. So as a leading data point that could potentially predict what we get in the official non-farm payrolls, then it goes ahead to show that the US job sector may have recovered and may be moving better than expected. So on the ISM services PMI coming in at 56.1 shows a very strong growth in the services sector. So also a key positive indicator for the US services sector. Then we have the crude oil inventories, which came in at 3.5 million, beating expectations of 3 million, but clearly a huge weakness from the prior reading of 16 million. So this shows that the number of barrels that are in US crude oil stocks increased by 3.5 million, which was significantly lower than the prior week, where we had 16.0 million barrels increase. So while this is a positive number, it shows weakness in terms of how much oil the US is adding to its stocks. So other than that, we have unemployment claims, which is a weekly data point, which is coming in at 4:30 p.m. And we're expecting this to slightly increase to 215K, up from 212K. So unemployment claims some time back used to be a key driver, but then as you can see, we don't usually have a lot of change in weekly unemployment claims. So in terms of market performance, we don't see that much that much impact in the markets. So normally it's usually within 3 to 5K change each month. So unless there's a big surprise, we don't expect the data point to be a key market mover. So this evening at 8 p.m., we'll be expecting a speech from ECB President Lagarde at 8 p.m. Then FOMC member Bauman at 9 p.m. And that will be just about it for the economic calendar today. So fast forward tomorrow at 4:30 p.m., we'll be expecting the official US non-farm payrolls as well as retail sales data. So both data happening at the same time means that we could have conflicting data points at the same time. We could also be getting data aligned. So let's look at the different scenarios. So on one side, the number of new jobs expected in the US economy for the prior month is 58K. So if we get 58K or higher than this, that will be a positive data showing strength in the US job sector. Of course, this would allow the Fed more room to continue holding interest rates steady, and as a result, it would mean a strong dollar. We already know that the outcome of the US-Israel-Iran war has been the dollar being taken as a safe haven asset, and as a result, the dollar strengthening against other currencies. So a much better than expected job market report would likely mean that we see a continued strong dollar. So on the other hand, retail sales month over month expected to be down 0.3%. Sorry for this. But then if we get a better reading than this, let's say negative 0.1, negative 0.2, or even 0% change, or even a positive number would likely mean a strong US economy, which would lead to a strong dollar. But then if retail sales worsen, then they could cancel out with the US non-farm payrolls. So if we see conflicting data points, then that would mean we get a whipsaw in the market. But then if we happen to see improving retail sales and improving job market data, then both would likely mean a very strong dollar. So unemployment rate is still at 4.3%, so nothing much of a change. So if unemployment rate, let's say, reduces to 4.2, 4.1%, then that also means a strong dollar. So what's the worst case scenario for the dollar? On one side, unemployment rate rising to 4.4 or above, that would mean a weakening dollar. If non-farm employment change comes weaker than 58K, that would mean we start seeing a weak dollar. And also, if retail sales worsen worse than 0.3, negative 0.3%, that would also mean a weak dollar. So other than that, there is other things happening in the markets as of this morning. We have seen some form of media blackout, especially with Twitter, where in earlier days of the conflict, we would see live coverage and videos being uploaded. But due to various limitations from various governments, where governments don't want their citizens reporting on what's really happening with their countries, that has led to a scarcity of videos and updates. So there's some form of blackout where people don't know exactly what is really happening in the Middle East. So from Reuters, you can see Iran launches a wave of missiles at Israel. US Republicans block measure to halt US air campaign. So the conflict is still continuing and accelerating, and the entire world is trying to process this, trying to wonder how their portfolios will be impacted. And as a result, we are seeing some form of calm before the storm in the markets, where after the big sell-offs happened on Monday through to Tuesday and Wednesday, today being Thursday, we are seeing more of a sideways performance in the markets. So, for instance, if you look at the MSCI stock indices, US Asia Pacific was on a strong bull run before the war started. Then we had a sell-off and then a rebound here. So the same thing happened even with the South Korea Kospi Index, where it was on a big sell-off. But now today we are seeing a strong bullish momentum, some form of recovery. You look at Europe index, a big sell-off followed by a strong bounce, but not full recovery. You look at the world MSCI index, big sell-off, some form of recovery. And also for American indices, there was a big sell-off, although not that big. and then the market has recovered a bit. So here now we are looking at potential sideways momentum ahead of the US non-farm payrolls, which could be a key driver for tomorrow. So as we mentioned on Tuesday, airline troubles mount as global flight cancellations top 23,000. So the financial and logistical troubles that Iran war is causing for the global aviation industry are compounding by the day, with the number of cancelled flights to Middle East hubs surpassing 23,000 since fighting began. Emirates, the world's largest international airline, extended its suspension of flights to Dubai through the end of Saturday, a full week since the US and Israel launched their joint attack. Qatar Airways extended its service halts into Friday. So, of the 36,000 scheduled flights to or from the Middle East since February 28, more than half have been cancelled, analytics firm Stadium Limited said on Wednesday, and that equates to about 4.4 million seats. Thousands of passengers have been stranded in the Gulf region, forcing many to take Qatar's expensive routes to reach functioning airports in Saudi Arabia and Oman. The UAE is establishing safe air corridors to allow for as many as 48 flights an hour, the economy ministry said. So as you can see, from Iran, there has been a closure of airspace in Kuwait, in Iraq, in Syria, and also part closures in Jordan as well as the UAE. Also notice that Bahrain and Qatar have also closed their airspace, which means that all the freight traffic in those countries have been cancelled, leading to massive hit in the airline industry. So between March 5 to 11, the airline is operating 3 additional flights between Delhi and Toronto. That's in India. Between March 7 and 10, 3 extra flights between Delhi and Frankfurt, 1 extra Delhi-Paris service. Running Delhi and Mumbai flights via Jeddah on March 5. Air India, and it's examining running additional flights beyond March 11 in response to high demand and the loss of flights run by Middle East carriers. So Air France, KLM has also been impacted. British Airways, Cathay Pacific, China Southern, Delta Airlines, Emirates, Etihad, Finnair, Indigo, Korean Air, Lufthansa Group, Malaysia Airlines, Oman Air, Qatar Airways, as well as Russia, Singapore Airlines, SpiceJet, Virgin Atlantic, all have been affected by the current war. So while all this has been happening, there is a shred of good news. So while Bitcoin had dropped to below $60,000 a few weeks ago, what we are seeing is a very strong rebound where Bitcoin topped 73,000 as investors look for a hedge. Crypto stocks surge after Kraken news. So Bitcoin rose 8% on Wednesday, with strategies pointing to the token's resilience amid market volatility tied to the Middle East conflict. A move to integrate digital assets into the US mainstream financial system and President Trump's push to advance crypto-related legislation also drove up crypto stocks and token prices. Bitcoin climbed to a one-month high above $73,000 as more than $680 million flowed into spot Bitcoin exchange ETFs on Monday and Tuesday. The broader market lagged on concerns that oil price spikes tied to the Iran war could reignite inflation. The ETF flows suggest that this is not just a short squeeze. They point to institutional allocators treating Bitcoin as a geopolitical crisis hedge, or potentially even as a hedge against future inflation, he added. That's from Coin Bureau co-founder Nick Pakrin. So Bitcoin is up 11% over the past 5 days. The token initially dropped to around $63,000, following the US-Israeli strikes on Iran, but recovered later that same day. ETH has also rallied 11% over the past 5 days, trading near 2150. So the move higher comes as Kraken Financial, the banking arm of the cryptocurrency exchange Kraken, was granted a master account with the Federal Reserve. It became the first digital assets bank to get direct access to the payment system used by traditional banks. So this is the first time that a cryptocurrency exchange is able to connect directly with the Fed and basically transact similar to traditional banks directly with the Fed. And as a result, this brought in more confidence in the crypto space. The approval granted for an initial one-year term will allow Kraken to settle payments on Fedwire, the core plumbing that banks use to move money between each other without an intermediary. So this is a sign that crypto may increasingly become integrated into the US core financial system. So as a result, what we saw was shares of Coinbase, Strategy, and Robinhood shooting up 15%, 11%, and 8% respectively. So despite the big sell-off that we saw with MicroStrategy shares, Coinbase shares, as well as Robinhood shares, now we are looking at a very strong bounce that could see some of these stocks recover what we had seen as a big sell-off previously. So, well, the good news is happening in the crypto industry. It's not so rosy in the oil markets. So, while surging oil prices may bite the hands of the Fed. So, as the conflict in Iran continues and engulfs an ever-widening swath of the Middle East, choking off transit through the critical Strait of Hormuz, oil prices continue to surge higher, forcing revaluations of previous assumptions about US inflation and the Federal Reserve's path for interest rates. Treasury yields climbed and expectations for rate cuts pared back this week as traders digested the risk that higher crude prices could slow progress towards the Fed's 2% inflation goal. For policymakers, the question is how much inflationary pressure does a sustained rise in oil prices create and for how long? As in 2022, war has proven to be inflationary as it is associated with negative supply shocks. The dogs of this war may bite the hands of central bankers given that the prospect of renewed inflation may come more hawkish monetary monetary policy signals. So what we are basically saying here is that as long as this war continues to escalate, we could be seeing much higher oil prices, and higher oil prices can cause consumer prices to move higher. And whenever we see consumer prices moving higher, then we know that that's inflation coming in. So at the same time, we also tend to see central banks printing even more currency to continue their war efforts. And increasing monetary supply also leads to higher inflation. So those risks are what the Fed is considering. And if you look at other factors, including supply shocks, for instance, the close of the Strait of Hormuz, the closure of the Gulf region, especially the Mediterranean Sea, would also likely mean that some products don't get to their destinations or they have to reroute, which would make deliveries slower and more expensive, leading to higher consumer prices. And that would lead to higher inflation, which would change the trajectory of the Fed as well as other central banks, especially the ones that rely on the Gulf region. And that basically summarizes it and makes it about the US as well as countries living within Europe. So in that case, we should be expecting much higher inflation. So if you look at the expectations for the Fed decisions over the next meeting, which will be happening on the 18th of this month, March 2026, so far the 30-day Fed funds futures on CME are showing that the market is pricing in a 97.3% probability that the Fed will be holding interest rates steady at 3.50% to 3.75%. So clearly, we do not expect a rate cut. The probability for a rate cut is only 2.7%. So this can be corroborated with what we are seeing in prediction markets. So if you look at Kalshi, which is the second biggest prediction market in the US, so far traders have placed bets worth around 17 million. And out of these bets, there's a 97% chance that the Fed will be holding interest rates. So only 2% of the bets are going for a cut, and 1% are going for a cut of 35 basis points. So clearly, prediction markets are going for the potential that the Fed will be holding rates. So poly market, the world's biggest prediction market, is giving it a 97.6% probability that the Fed will be holding interest rates at the current level. So clearly, this is quite bullish for the dollar, given that the bets are based on where different participants have placed their money. So other than that, I'm trying to see something else. So we had a one Fed member, Kashkari, who said that it remains unclear whether the Iran war will influence inflation or shape monetary policy decisions. So Neil Kashkari, president of the Federal Reserve Bank of Minneapolis, said it is too soon to know how the Iran war will affect inflation. He said the shock could affect monetary policy, and the Fed needs to see how large and how long it lasts. So this basically means that the Fed is likely sitting on its hands, waiting to get more data before it makes the next decision. He said elevated headline inflation needs monitoring given that the recent path. Said inflation is too high but trending down, and the Fed must reach its 2% inflation target. On the question of monetary policy and neutral rate, Kashkari said he had thought monetary policy was in a good place, but more data are needed to decide what to do with rates this year. He said the strength of the economy points to a higher neutral rate, with near-term AI investments probably pushing it up. He said uncertainty about the tariff outlook has increased. He said he does not think the latest round of tariffs will create fresh inflation, and he does not see much chance of tariffs rising substantially. He said the labor market is in a decent place, but there is not much underlying demand for labor. He said that before the Iran attack, the Fed's job and inflation mandates felt more stable. Said he's not hearing much from the business sector about more inflation coming. He said he expects inflation pressures and housing inflation pressures to end this year, and that March Fed forecast will show more uncertainty. So other than that, trying to see if there's any key highlight we may have missed. Just checking to see if we missed anything. So from the Forex side, the US dollar is still the strongest currency as per the day. The Australian dollar is the weakest as of this morning. New Zealand dollar as second weakest. But then all the major currencies are giving room to the dollar. And for the week, the dollar still remains the winner for these, I would say, currency safe haven battle. So whenever there is a geopolitical conflict or basically war, we normally see investors rush for safe haven assets. So while on one side, there is that battle between which asset is much better as a safe haven, between gold, silver, Bitcoin, and many other assets which could be classified as safe haven bets, including going defensive or even buying defense stocks. On the currency side, it's a different ball game. So investors will be evaluating which currencies are more impacted, and then they will go for the one they trust the most, where they know the central bank will most likely not default. So in this case, the biggest bets have been on the US dollar, which has been a winner since the war started. So all major currencies have lost to the dollar, with the euro being the biggest loser, down 1.68%, Swiss franc 1.44%, New Zealand dollar 1.18%, pound 0.98%, Australian dollar 0.92%, and JPY 0.79%, while the Canadian dollar has a very slight drop of 0.08%. So as we mentioned on Tuesday, the reasoning remains true. The dollar is the biggest bet, mainly because we are seeing investors' trust in the US economy retaining its strength despite what's happening in the Middle East. So on the Canadian dollar side, we know that the Canadian dollar is positively correlated with the price of oil. So a big spike in the price of oil is also a big spike in the Canadian dollar. So we see positive correlations between the two. Then we have the Japanese yen, which is traditionally it has been used as a safe haven currency. So whenever you see there being a war happening around the world, investors also tend to bet on the Japanese yen, mainly because Japan doesn't get involved in external wars. So for the Australian dollar, it's due to the correlation with gold, where we were seeing it holding. But then the margin calls were so big that investors started selling gold. So the big scare that led to the big sell-off on US and European equities, as well as Asian equities, between Monday, Tuesday, and Wednesday, led to a lot of investors offloading some of their positions in gold and silver. And as a result, we saw gold and silver dropping. And when they dropped, also the Australian dollar started weakening. But then the rest of the currencies have just been losing to the dollar. So the US stock market has weathered some of this panic. And as you can see, as per the trading yesterday, we had a lot of neutral activities happening yesterday, meaning that most of the stocks didn't move over 1% to the close. So clearly, we have one clear winner, which is Broadcom, which was up 7.74%, despite other stocks not moving. Robinhood, as we have already mentioned, gained as a result of the current rally that we saw in Bitcoin, ending up 3.65%. So Coinbase was also a net gainer, up 1.80%. We also had Ampheno Corporation up 2.94%, but most of the stocks had a retro movement yesterday. So as for the, trying to see the 1 week performance. Yeah, so as for the 1 week performance, still the industrial sector, aerospace and defense, we have seen a lot of investors hedging in that direction, going for defense contractors that are bound to benefit from the current war. Software and applications, also mostly in the double-digit sector. Palantir, we mentioned, is a key supplier of surveillance software, up 13.08%, as the US government could be using their software in operations in the Middle East. And then the rest of the market took a big hit, with capital markets taking a big hit, banking sector taking a big hit. Semiconductor sector was also not spared, especially semiconductor equipment and materials, consumer defensive, household and personal products, as well as non-alcoholic beverages also taking a big hit, including tobacco. You can see Philip Morris taking a 4.79% hit on the week. So other than that, I'm trying to see if there's anything else I may have missed. Yes, on the Fed side, we know that Jerome Powell is going out in May. So there has been a succession battle, and so far now we know exactly who is succeeding Jerome Powell. So Trump officially nominates Kevin Walsh as a Fed chair to replace Jerome Powell. So President Trump on Wednesday officially nominated Kevin Walsh to be the next Fed chairman. So Walsh, if confirmed by the Senate, would replace Fed chair Jerome Powell for a 4-year term. Trump's nomination was transmitted to the Senate, the White House said in a statement posted online on Wednesday. So clearly now we have one of Trump's favorites who would likely bend to Trump's pressure to continue cutting interest rates and get them to the desired 1% target. So that is it on the news front. And now I believe you can jump straight into our favorite part of the presentation, which is technical analysis. So on the technical analysis side, we cover the major currency pairs, top equity indices, top commodities, including gold and oil. And once you cover this, hopefully everyone can trade from an informed perspective. So always remember that these sessions do not constitute of any form of investment advice. They're not a recommendation to trade. So you should always do your own due diligence. So afternoon, Limokevi. I can see Sheru Joseph in the house. Thank you guys for joining. So let's progress. So far, unconfirmed reports are basically showing that increasingly, Gulf countries are refusing to give the US their airspace to continue striking Iran, mainly because Iran's response, whenever hit, it's hitting those countries and not hitting the US. And this is impacting their economies and how they are managing the situation. So there has been a lot of negotiations between the Gulf countries around Iran and whether they will be allowing the US to use their airspace to strike Iran. So that is becoming a point of contention, which means that Iran is getting some level of success in terms of pressuring the Gulf nations to stop facilitating the US and Israel in progressing or escalating the current war. So, what we are seeing here is the chart of gold. This was the market reaction on Monday, where we had a gap up and the market closed the gap and then later dropped. So on Tuesday, we discussed the potential of the market bouncing from here and moving higher, but that didn't happen. As I mentioned, I was wrong on my analysis, and I expected gold to move higher. But then what we saw is a much bigger sell-off where in a panic situations, correlations can approach one, where a lot of investors go for safe haven assets. So given yesterday's price action, we have a range-bound market. So I'm trying to map yesterday's high and low, and from there we look at today's price action. So yesterday's high and low can be assumed to be around this area here. So just give me a sec. Yes, from yesterday's open, open was here, but then I'll use this one, which clearly tracks the New York session lows. And you can see the price action in gold prices yesterday, and compare that to today. We are within range, and volatility has actually reduced. If you look at the range between the high and low, it's much smaller compared to yesterday and smaller compared to the prior day, which basically tells you something that this market seems to be consolidating around this area, waiting for the news of a fresh driver. So you look at this price action here, you can see we are almost in what I would call a triangle of some sort, an asymmetrical one for that matter. And this means that volatility was highest here on Tuesday, smaller on Wednesday, and today being Thursday, even smaller. And this means that the markets are indifferent. They don't know whether to continue with the panic selling or whether to continue with a recovery, because this could be a dead cat bounce. So that indifference has led to sideways momentum, which means that we should be able to track what happens if gold breaks to the upper side or if it breaks to the lower side. So far, the market is not very interesting. It's not giving us a directional move. And without a directional move, we might as well be trading in a range, or what we call a sideways momentum. So gold is range bound, and at some point we expect it to break. If it doesn't happen today, then the breakout will most likely or most definitely happen during the non-farm payrolls tomorrow. So be on the lookout for this. It basically says it's a wait and see kind of a market. So while that may be true for gold, silver hasn't been uninteresting. Despite the big sell-off happening on Monday, followed by Tuesday, Wednesday was more of a sideways momentum, and today we have seen a very interesting thing going on. So if we map the movement of silver as per yesterday, we look at the high and the low of the New York session. Then you can see what happens. Today, market started to go up, and then a very sharp drop, which was immediately met with a reversal back to mean, meaning that all the losses we saw here have already been covered. So now zooming out, you'll notice that now we have this area here, which tracks as the resistance for this particular market. So a 3-day resistance, and you look at a 2-day support area, which basically tells you we are also in a triangle, triangle of some sorts. So clearly, the market has been trading within these two trend lines. And what we are seeing here is a market that won't continue moving further downwards, won't continue recovering and move higher, has remained within those confines. So the idea is to track if silver breaks this area here and moves higher, or if it breaks this area here and moves lower. So far, without that, we would assume that this market is also in a symmetrical triangle. But one interesting thing is that there was this liquidity grab earlier this morning. So good chance that we see a breakout later today, but then most definitely during the non-farm payrolls tomorrow. So you look at the UK oil and what happened over the weekend. So there was this big jump at market open. As a result of the war, oil was definitely going to be impacted. And with several countries closing their oil production plants, this led to the belief that there would be scarcity in the markets, leading to higher prices. So there was an 8.8% jump before oil erased some of the gains to 3.59, but then closed slightly higher, up 6%. Then the move expanded on Tuesday, where oil was up 15.88% on the week, before dropping sharply, still up 6.8%, closing high, up 11%. Then we started to see more of this sideways momentum happening from Wednesday through to today, Thursday. So what we are seeing here is more of a sideways momentum in oil, and the range basically reducing. So if you look at yesterday's high and low, and then today's high and low, you'll notice we are trading within that range. So it's safe to assume that some of these markets are range bound. So we can say that from Tuesday afternoon to today, these markets haven't been moving in a trendy manner. Rather, we have been seeing more of a sideways momentum in oil prices. So unless there's some form of break and we start betting on continuation, then we assume that the market is going to remain within this range. So talking of range-bound markets, we have been looking at the Nasdaq, and the Nasdaq has been quite volatile. So if you look at the daily time frame, yes, you can see we are in some form of range. This is something that has lasted the last 6 months. So meaning that the Nasdaq has just been moving sideways for 5 and now getting into the 6th month. On a weekly basis, you can see all this volatility moving up and down. And in the most recent swing, we just bounced from a key level support. So the support can be seen on different swings here. And the most recent resistance seems to be around this area here. So if you zoom in on the weekly chart, clearing, you'll notice that there was a bit of a sell-off at the beginning of the week. Then the Nasdaq recovered. So far it's in the positive so far in the week. Then you move to a smaller time frame. You notice the big sell-off that started last week. The weekend gap, which was eventually closed on Monday. Sell-off on Tuesday, recovery on Wednesday, and today we have been seeing return to normal movement ahead of the official non-farm payrolls, which are expected to be coming up tomorrow. So I wouldn't expect much of a momentum today, knowing that the markets are quite uncertain. But then volatility usually comes in during the New York session. So we'll be observing these very short-term trend lines that started this morning. And I would be on the lookout for a break. I don't expect the markets to aggressively get into a rally, but then a panic sell would be very interesting this afternoon, especially if the market was to break this area here. So you look at the US 30 or the Dow Jones, still on a very strong bullish momentum. So notice that on the daily, we were able to retest this particular trend line here. And on the retest, there was a very strong bounce. And also, we had this particular trend line on this edge. So zooming out, you'll notice that it was towards the retest here. But then if you go to a small time frame, in this case, the H1, then you'd notice that the trend line led to a retest of this particular bounce. So on the upper side, we've had this relatively strong resistance area acting as the area where whenever the market gets around there, we tend to see a rejection of higher prices and the market moves further back downwards. So we are approaching the same area, which we had also approached yesterday. So on the short run, you are able to notice this and the rejection that just happened an hour ago. So the idea is to look for potential short sell around this area here with the expectation that the market will retest this area here before moving further back downwards. So this is an idea if the market remains within this channel. So on the US 500, it's a similar thing. So from the daily, you can see that this is a sideways market and has been for the last couple of months. I'd say 4, 5, 6 months. 1, 2, 3, 4, 4, 6 months. It's a sideways momentum. Nothing much has been happening with the SP 500. So you go to the weekly chart, you see the strong bounce after the sell-off here. But now we are getting stuck at this resistance. So from the H1 time frame, I'm talking about this area here being a key level resistance area that the market is unable to break. So with today's price action ahead of the official non-farm payrolls tomorrow, nothing much seems to be happening here. So you can see clearly this was a retest of this area here. So this area was acting as resistance. Market goes back to it. This was the highest we got on the recovery journey. And from yesterday afternoon up to today, this is more of a sideways momentum. So we don't have a break yet. So we should be focusing more on the potential break. That hasn't happened. So I'll be looking at today's high as well as today's low as potential entry points if there is a breakout. So while that may be happening, and sideways momentum is observed, on the currency side, this is what we are observing. Market that is also quite volatile. So if you look at AUD/USD on the 4-hour time frame, yes, it's more of a sideways momentum market. Uh, so for several weeks, we would say there hasn't been an observable momentum. So notice the sideways momentum for the last 3 weeks, and now this is the fourth week. We are seeing sideways momentum, and from the 1 hour time frame, we just tested the lower side of this range. And after testing the lower side of this range, we can see the Australian dollar bouncing strongly and trying to move to the upside. And of course, the target would be the day's high, an area that the market was unable to cross just past midnight. So other currencies are also taking some strength against the dollar. So for instance, USD CAD, which is also in a range-bound sideways momentum. You can see that earlier in the morning, the dollar was gaining against the Canadian dollar. Now we are seeing a reversal, which would likely mean a retest of this support level at 1.36250. So New Zealand USD, strong bullish momentum in the dollar earlier in the morning. We pulled back, retested the same area. So notice that this was the high of the day, and we retested that area here. And now we are seeing the market moving further back downwards. In this case, the New Zealand dollar losing to the USD. So perhaps a retest of the New York session low. So this area here is expected to be the range for the currency pair. So nothing much of a movement above or below. So more of a sideways around this area. So for pound USD, what we are witnessing here is something we discussed on Tuesday, a sharp sell-off in the pound against the dollar, which played out as expected. But then we have seen the rebounds and market making a recovery. So from here, you can already tell what's happening. It's a market that is entering some form of weekly consolidation. So Monday high, Tuesday high, Wednesday high, Thursday high. So while the lows are not following the same path, if you look at the low of Monday versus the low of Tuesday, they were both moving lower. But then from Tuesday to Wednesday and then Thursday, then this is what we have here. So this is a market that has been consolidating, basically moving sideways. So nothing much here. So more of a sideways momentum. And right now we are seeing volatility getting lower and lower, which means that trades on the break will be very important. So let's wait for it, wait for the eventual break. That hasn't happened yet, but we know it's coming. So Euro USD also on some form of sideways momentum. So we discussed the potential sharp sell-off on Tuesday that we targeted at 1.15809. But then after that, all we have been seeing is sideways momentum from the euro. By sideways, I mean a complete sideways range from yesterday. So nothing much is happening here. We just got to the upper side of the trend line, and now we are just moving to the lower side of the trend line. So this is a classic range in Euro USD. We don't expect much to be happening in this market. So this is a market that is just indifferent. So dollar Swiss franc, strong rally. This was our target on Tuesday, 0.878610. After that, this is what we are seeing. So let's map the small patterns within the patterns. This is our resistance for the last 3 days. And key level support could be mapped to around these areas here for the last 3 days. So with this being the activity from USD trading against the Swiss franc, so nothing much is happening here. So clearly you can see we had a sharp drop. Now we are moving up, but then we don't have a break yet. So the idea is to be trading on the break. So if there is a break, then we trade in that direction, but it hasn't quite happened yet. So let's be on the lookout for that. Dollar yen also showing similar things. This was our target some time back. That was on Tuesday. So you look at the H4. Sorry, that was some time back, not Tuesday. So this is what we are seeing with the dollar yen. So from the daily time frame, the dollar has been pretty bullish against the yen despite the sell-offs in the last 2 weeks. So any attempt to sell off the dollar against the yen is being met with a strong recovery. So Monday, Tuesday, Wednesday was basically Tuesday, Wednesday, recovering from what happened on Monday. And then today we opened extremely bullish. We had a pullback, and now we are looking at a continuation. So sorry for that. That was the weekly, not the daily, and the day to day. So what we are seeing here is a very strong bullish channel happening in USD JPY currency pair. So we just bounced from a value area on the lower side. So if you go to a smaller time frame, in this case the 15 minutes chart, then you'd notice that this was pretty much the resistance in the market as per yesterday. And this has been broken and retested, quite a book pattern that we usually follow. So whenever you see this market breach a resistance area, a retest and show continuation, then we know that we are in for another push. So in this case, a push towards the upper trend line. So we should be looking at an extension here. An extension of this particular trend line. So potential extension and rally to 158.8. Betting on a strong dollar against the yen as the market remains within this channel. So this seems like a likely trade of the day with bets on a stronger dollar against the yen. So that could be a very nice play, given that from what we discussed about US interest rates and the potential for the Fed not changing interest rates on the next meeting, then we expect that the dollar will remain strong and the yen. We don't expect the Bank of Japan to be hiking rates on the next meeting. So clearly seems like a clear winner today for the day. So the Nikkei 225 index had a big sell-off at the beginning of the week, found some support at an area we had identified as a key level support at 54,074 price level. So from the H1 chart, notice how we bounced from there. We retested and pushed even higher yesterday. So today the market pulled back and found a key level support. And if you look at the smaller 15 minutes time frame, we found the support, retested it, and now a push. So if this was the Asian session low, on the London session, we retested it, and now we are moving higher. So potential targets include high of the day, which are targets that could be hit as soon as tomorrow. So good chance that the market goes for this resistance. So for the UK 100 index, bit of a sell-off at the beginning of the week. Yesterday, some good recovery, and today, more of a slowdown. The volatility seems to be weakening, but then we have a pattern within a pattern, which likely means that we are trading in this channel. So a bit of a sell-off, think of it like going down the lift and then climbing up the stairs. So the climb is a little bit slow. It's not like a V-shaped recovery. So a retest of this area could be termed as a value area, and then we look at a more bullish momentum. So the Hang Seng Index from Hong Kong was more in a sideways range. But then you can see the sharp sell-off happened to bounce exactly at a key level support, meaning that the pressure from the sell-off as the markets panicked from the war is gone. And with that pressure gone, we now begin climbing up the stairs. So from the H1 chart, you can see the strong bullish momentum as per yesterday. And then for today, we are beginning to see a progression where today's low is much higher than yesterday's low. Today's high is much higher than yesterday's high. So now we start seeing the zigzagging happening here. So markets going down to the lower trend line, bouncing off the lower trend line, moving up higher, which is a thingy that we normally see when markets are recovering. So from the lower trend line, we zigzag up to the upper trend line, then lower, then upper, and so on, up until the market picks up the momentum. So that's it on the US side. We haven't checked the European equity indices yet. So remember on Tuesday we were facing this sell-off. So we identified a target of 23,847, though the market fell a bit lower. That is for the German DAX. So now we have seen the market make an impressive recovery since then, and that recovery is also taking shape. So down the lift or big panic sell, followed by a slow but sure recovery. So here we are seeing the market going for it. So a recovery, which is now looking to test the upper trend line, and then we continue zigzagging on our way up. So that's for Germany. So for the EU 50, this was our sell-off. Our target was here. But then since that period, what we have been seeing is the market attempting to recover. And as I mentioned, now we start zigzagging on our way up. But then remember, some of these bounces could be what we term as a dead cat bounce. So dead cat bounce is where the market shows you a bullish momentum after a big sell-off, mainly as a relief the sell-off. And then if there's more factors contributing to further panic, for instance, if let's say new weaponry starts being on critical. So that's why it's very important we monitor the staircase here where the market starts zigzagging because, for instance, a breach on the lower trend line would mean more panic coming in and going for previous lows. So that hasn't happened yet. So before that happens, for now, the market is in this zigzag and we expect more bullish momentum. So French 40 stock market index, this is a classic range, sideways momentum. It's not a channel, it's not a triangle, it's just so sideways momentum for two and now that consecutive day. So we are playing against the resistance here. So of course, we expect the market to drop back to the lower side of the range. And then if there's a breach, then we go for the gap. If there's a breach here and the market goes up, then we go for the Monday gap here. Sorry, for the Tuesday gap here. So clearly that hasn't happened yet. So the market is still in a sideways momentum. So you look at Swiss stock market index on the 15 minutes chart, also in a sideways momentum. Nothing much has changed here. So after the sell-off on Monday and Tuesday, Wednesday, Thursday is sorry, on Friday and on Monday, then Tuesday and Wednesday have been sideways, and today being Thursday, we just went straight for support. Market bounced from there, and now we are moving upwards. So Netherlands stock market index for the week is making an impressive recovery. So key level resistance is at 1,012 price level. So clearly, these are more of a market that has been moving sideways, which means that the US non-farm payrolls tomorrow are about to be very explosive. Of course, any updates from Trump from now on could cause volatility in the markets. So it's one of those markets that we describe as a wait and see. So for the US small cap index, or what we call the Russell 2000 index, it's still bullish. Had a bit of a sell-off, panic selling at the beginning, but then after the markets opened on Tuesday, Wednesday, what we are seeing is a change, and this was one of the markets that was trending, despite SP500, the Dow, and the Nasdaq moving sideways for months. This one has been quite predictable on the bullish momentum. So recently, pushing further back downwards, and on the 1 hour time frame, you can see the big sell-off on Tuesday and then Wednesday recovery. And today we are attempting to complete the journey towards the upper trend line. So we should be expecting some bullish momentum on the break, especially during the New York session open. So I can see there is a couple of questions. So good question. Kindly confirm something with this, Irano. Why is it that the dollar is still gaining? Yet we should consider the war as a geopolitical tension which would have led to investors settling for assets or rather gold. So what is actually happening is that a lot of the world is heavily leveraged right now, meaning that a lot of investors are holding heavy positions, especially with big exposure to AI. That has been a big driver of the market over the last 3 years. So with this kind of exposure, investors often hedge with safe haven assets. So they might hedge with the bonds, they might hedge with the dollar, they might hedge with silver, with Bitcoin, and so on. So what we are seeing happening is panic selling that happened on Monday and Tuesday. So this panic selling means that investors need to cover. So the panic selling is mostly from retail. So big banks and hedge funds, whenever they are caught in a bad trade, what ends up happening is that the price of that position or the price on that leverage gets to increase, and as a result, they need to cover that, so they sell their winners. So selling their winners means including selling some of the best performing stocks. So that's why you saw the biggest rout happening in the tech sector, but also selling some of the best positions, which includes gold and silver, which were the clear two winners of last year. So if you've been holding this position and have given you some really good returns over the last 1 year, you might want to sell some to continue holding your losing equity positions. So these big banks and hedge funds, they know that the stock markets always go up. So rather than getting liquidated, what they do is provide more margin to cover their positions, and that means including selling their winners. So while this is happening on one side, on this other side, we see more demand for dollars. So a lot of investors would exchange their currency for dollars up until the end of the conflict. So as long as you are unsure of how the conflict will proceed, so investors will go for the most in demand, most stable currency in the world. So in this case, they tend to go for the US dollar. So on the other hand, when investors, let's say, sell some of their winners to stay off the markets, let's say you had a very risky bet in a US stock, and due to the uncertainty caused by the war, you had some dollars in an Israeli stock, an Iranian stock, a Dubai stock, and now there's uncertainty in the market, and you decide to sell that stock, which you can evidently see from the sell off in stocks on Monday and Tuesday. Now you get the dollars, you don't hold on to the dollars. So there is no increase in supply of dollars. So for investors, their goal is to make returns. So what they do is that they go for short-term paper. They go for US treasuries. You buy a short-term paper. So the return will be minimal, but that paper will at least give you something with a guarantee rather than holding a risky stock, not knowing how far this war will escalate. So in that case, you find more and more investors going for short-term paper, which basically drives into dollar scarcity. And as a result, you see the dollar strengthening even during a geopolitical conflict. So clearly, the dollar is getting stronger. That is so far for the week, and we could be seeing this progressing further. So good comment here, challenging my point of view. Dollar is getting weaker, not stronger. There is liquidity sweep at a church. That is what DXY is going down, not up. I don't know about that. Let's see. Yeah, so this is the dollar index. So on average, you can see this is our 1 hour chart, and from roughly 9th of February, or go all the way back to 28th of January, the dollar index has just been moving higher. So the most recent momentum having happened between Monday and Tuesday, where the dollar index kept going up. Then Wednesday and Thursday, we have seen sideways momentum. And as we have seen with other markets, there has been more of a sideways momentum. So this doesn't mean that the bullish momentum in the dollar index has ended. So as long as the conflict continues to escalate, there will be more likely scenario that the dollar index breaks higher and moves for 100. But then this 2-day momentum has been just sideways. But then the prevailing momentum, which happened on Monday and Tuesday, was the dollar strengthening. And these can be seen as the dollar strengthening against other currencies. So I would say that's all for today. Thank you very much, everyone. So also remember to check out the latest episode of the British Banter podcast, where on the latest one we covered Saruni. We have a new episode covering a trader who doubles up as a teacher. The episode is coming out later today, perhaps latest tomorrow. You'll see a trader who is able to double up as a teacher and how they approach the markets, how they analyze the markets. This will be a very interesting episode. Saruni, regional coordinator, operations manager at Binance. We covered him in the prior episode. Make sure to check it out. We have a Kenyan economist, Derry. We covered him 2 weeks ago. And many other episodes of the British Banter podcast are available on FXPesa YouTube. All live streams are recorded Monday to Friday. So in case you want to review a recording that we did, or in case you want to rewatch today's video, make sure to check it out. Also, one important playlist I would like to show you is the Novice to Pro course. So if you're a beginner and you're looking to learn how to trade Forex, check Novice to Pro with Rufus Kamau. These are a sequence of 10 episodes that will get you started from introduction to trading all the way to trade like a pro. Once you check it out, go through each episode by episode, and these will help you understand what's happening in the current market snapshots. So that is it for today. Thank you very much, everyone. So this other question here, it's not a short squeeze. It's just a bounce as a result of the progression with US legislation, and of course Kraken being able to plug their network directly into the Fed. So that means that banks will be able to offer Bitcoin directly. So as a result, we saw the strong rally. But then be wary, it could be a dead cat bounce. It really depends on the progression that we see in this war, which could lead to more momentum in the markets. So far, the dollar index the dollar is still the strongest currency in the market. And for the week, it just flipped when we were doing this session, with the Canadian dollar taking precedence, and mainly as a result of the strong correlation between the Canadian dollar and the price of oil, which is obviously moving higher. So that is it for the day. Thank you very much, everyone, and I hope to see you on the next session.